Hi, everyone. Welcome and thank you for tuning in to this podcast. My name is Martin Lefebvre. I'm Chief Investment Officer at National Bank Investments. And today I have the pleasure of being with Louis Lajoie, our Senior Investment Strategist and Portfolio Manager of our asset allocation mandates, to talk about top of mind topics such as inflation, rising rates, and market opportunities. So, first things first, Louis, welcome and thank you for being with us.
Thanks, Martin. Happy to be here.
Excellent. So, Louis, last summer, central banks were telling us or suggesting that the rise in inflation would be transitory. And at that time, we were hovering around 5% in the US. And all of a sudden, we're up to 7.5%, a 40-year high. So what's going on? What's your stake on the matter?
Right, indeed. I think it's fair to say that the situation didn't evolve in the direction desired by central banks. As you said, CPI at 7.5% is quite something. But perhaps I think more interestingly is the fact that inflation price pressures became much more broad-based over the past few months than they were back last summer. And that's the message that we see from other inflation measures, such as the one from the Cleveland Fed, the trim mean inflation that excludes the most volatile components from the CPI baskets, that now stands at 5.4%. So quite a change in just a few months. And the question we get asked a lot because of that is, are we in the camp of those that think that inflation is transitory or persistent? And that's a debate that's really polarizing within the investment and investors and economist communities. But as is often the case, I think there's elements of truth in both camps. And given the fact that there's multiple inflation dynamics at play simultaneously. So to start with, I think there's no doubt that there are transitory elements behind the surge in inflation. The presence, but the persistence of the pandemic has clearly an effect on spending patterns, namely to concentrate them into consumer goods, just as supply of goods was affected by a succession of ports closure, factory closures, given the pandemic. So that has led to multiple supply chains issues. Now, consequently, if you look under the headline CPI figure, you would see that durable goods prices are actually up 18% year over year, which is something that we have literally never seen, not even during the 1970s. And an example of that 18% is the 40% increase in used cars and trucks. So, substantial movements in terms of price of goods. Just to give a bit of perspective on that front, if you look at durable goods historically over the 20 years before the pandemic, its average inflation was actually minus 1%. So it's hard to argue against the idea that there is a transitory or an outlier impact at play here behind the surge in goods. And in fact, we did see some price pressure easing in Q3 last year following the peak from the Delta wave. But with the arrival of the Omicron wave, we had seen several high frequency indicators, price indicators such as the cost of shipping containers from China and the price of semiconductors as well. They had moved back up quite substantially near record highs. So unsurprisingly, we did saw the price of goods still quite high. Now, when we look ahead, I think it's reasonable to expect that these trends will eventually abate over the course of the year. It's certainly not going to happen overnight, perhaps not even this quarter, but assuming that the pandemic finally takes the back seat and stops having a material impact on our day-to-day life, I think it's reasonable to expect consumption patterns to start to migrate from goods to services to get towards a more sustainable balance that will ultimately ease pressure on overall prices. And in any event, we're already starting to see inventories picking up quite substantially. So companies clearly have started to have been able to adapt to some extent to these challenges on the supply chain fronts. And so even if demands for goods remains relatively strong for still a few more months, I think it's quite clear that prices will eventually stabilize as supply picks up this year.
Thank you, Louis, for that. It's very interesting, and what we hear from central bankers most of the time is that they don't have much grab on supply shock issues, which is clearly the case here with this pandemic-led shock on many items. So, are there more persistent factors to think about, owing to the fact that forward guidance from central banks is pretty clear that they will start increasing interest rates pretty soon?
Yeah, definitely. There are definitely other factors at play here. And just to be clear, even though goods inflation will definitely come down this year, overall inflation is likely to settle, relatively high at a relatively high level from a historical perspective a year from now. Certainly lower than today, but probably higher than in recent or say the last 10 years. And the reason for that is, as you said, more persistent or structural factors at play, one of which is the cost of shelter that is almost certainly going to continue to rise over the course of the year. We see a historical relationship, a lagging relationship between housing prices and the cost of shelter that carries a significant weight in inflation baskets. So that's going to remain well supported this year, given obviously the sharp rise in house prices that we are all aware of and that took place over the past 2 years or so. But more interesting, I think, and more important factor to keep an eye on this year and even beyond is the impact of labor scarcity on wages. Now, virtually all indicators we look at in terms of labor demand are at peaks. But even beyond that, in the very real world, I think we just need to take a walk in any downtown or talk to any business owner, and they'll clearly you'll see a clear situation of labor scarcity on both ends. And this, if we look at in the US, we see that this has already started to have an impact on wage growth. Wages are up as much as at the record pace that we haven't seen in the past 20 years. And again, this situation is also to some extent exacerbated by the pandemic, given that many workers either moved up their retirement plan, decided to change careers, simply took their times given the amount of excess savings that they had accumulated during the pandemic. So there are also a transitory part to that story, but even beyond that, demographic trends don't lie. With a larger share of population moving from primarily workers to primarily consumers or retired, if you will, that should continue to put a tailwind on wages over many years, which in turns impacts mostly services inflation. So labor scarcity is going to be a challenge for years to come. But it's not only, there's also positive things at play here. It's not only bad news. Obviously, we're coming out of a decade of fairly low wage growth. So seeing it picking up is good news to some extent. And what's also interesting is if you look under the hood, you'll see that it's mostly the lower wages part of the income distribution that are seeing the strongest growth, which in turns obviously helps reduce income inequalities that are, again, super important for social cohesion. So that's something rather positive. In my view, there's ground for optimism, but for as long, obviously, as headline overall wage growth remains at reasonable level, that's the case for now, and we have to keep an eye on it just to ensure that it remains the case. But I think there's valid reasons to believe so.
Okay, perfect. So a little bit of transitory factor that are easing, but some perhaps persistent wage push kind of inflation. So it's not surprising to see that central bankers have sort of increased their expectations of rate hikes. So we went from, not so long ago, only 3 rate hikes to almost 6 rate hikes now expected by the markets. Is that a reasonable expectations?
Indeed, it's quite a pivot from Mr. Powell, the Fed chairman, that we witnessed over the past few months. And in his defense, his approach that he labeled as wait and see over most of 2020 and 2021, it was justifiable given just how unprecedented, the post-pandemic economy was, and when we had, very little visibility on the near-term course for the economy. But that's no longer the case now. Not only do we better understand the virus now, and we've largely adapted accordingly, but we've also obviously seen inflation rise substantially, as I've talked about quite a bit over the past few minutes, but especially the labor market that has recovered almost entirely over the recent weeks and months. For instance, with the unemployment rate in the U.S. that currently stands at 4%, so essentially within the range that the Fed deems to be in line with its full employment mandate. So it's obvious that the time has come for interest rates and policy rates to normalize, and we would be otherwise, I think, very worried if central banks weren't projecting rate hikes over the coming months. Now, is it going to be 6 as markets currently expects for the next 12 months, or is it going to be 4 as our economists here at National Bank expect for 2022, or 5 if you include early 2023? Honestly, I don't know which number it's going to be, but what I do know is that the speed and magnitude of rate hike expectations that have been priced in over the past few weeks, it leaves little room for markets to discount even more tightening from this point. And more importantly, I think we're starting to see some yellow flags show up on markets that should limit the potential for even more aggressive monetary tightening on the part of the Federal Reserves. And to be specific here, I'm thinking about long-term inflation expectations. So even though we've seen, CPI at 7.5%, the reality is that over the recent weeks, long-term inflation expectations have actually moved significantly lower and even below the Fed targeted range over the long run. So that's something to keep in mind. And the other thing that we saw in markets is the substantial yield curve flattening that we've seen recently. That we're not yet at an inversion, to be clear. An inversion as historically signaled when the Fed had gone too far. We're not there yet, but when we look at forward rates, we see that this could very well happen a year from now should the Fed be too aggressive. So that's a yellow flag, I think, that the Federal Reserve will likely have noticed, and we'll have actually more information with regards to the Fed's intentions at its next policy meeting on March 16. They'll evidently hike rates at this meeting, but more interestingly, I think they also provide an update on their projections, and markets, just like us, will be very attentive to that. But at this point, I think it is clear that we're due for a normalization of rates. It's absolutely necessary. I'm just not sure that the economy really requires the Fed to slam the brakes on demand. What the economy mostly needs, I think, is simply time for demand to start to migrate and be better distributed between goods and services, which hopefully a definite end of the pandemic as a crisis should bring about.
Okay, so we're not too sure about how many rate hikes will be necessary, but one thing is sure is that we will probably see interest rate hikes starting in March. So what does it mean for a client's asset allocation, Louis?
Yeah, for investors, I think as we've seen early this year, 2022 will certainly not be as comfortable as 2021, and that holds for both the bond market and stock markets. So first thing, I think investors must temper their return expectations. We're coming out of a period quite profitable, especially on the stock market. We should also expect more volatility against this background, but we still think a pro-risk asset allocation is warranted at this stage in the cycle. And for instance, if we look at equity markets, we've seen that historically, whenever the Fed started a rate hike cycle, stocks have always been more volatile in the months around that first rate hikes, with pullbacks in the range from 5 to 10% quite often. But what we also see is that beyond these fluctuations in the near term, in every cases since the 1990s, where the Fed started the rate hike cycle, 12 months afterwards, stocks were higher, stocks were carried higher by actually earnings growth, which goes to show that whenever the Fed starts to hike rates, it's certainly because the economy is showing great strength, great momentum. That's definitely the case as at this stage, and as such, we do expect the stock market to remain well supported. Now, for bonds, the backdrop should remain challenging. It's been quite challenging for a few months now, but I think a lot appears to be discounted at current levels. So I think it's fair to say that the worst is probably behind us for the bond market. If you take, for instance, 10-year U.S. Treasury yields, given how fast they moved all the way up from 1.4 to 2% since the beginning of the year, I think they're likely due for a consolidation phase. And beyond that, in this cycle, we would be surprised to see them rise above 2.5%. So in other words, if you start from the low point of the 0.5% reached at the summer of 2020, and assuming that the ceiling in this cycle is 2.5%, that means that we've already went through at least 3/4 of the normalization process of long yields. So this background still argues for shorter duration position. It still makes sense. Tactically, we hold a cash position, notably for this reason. But again, stagnation is probably a better expectation of the near future than a sustained drop for bonds. Now, finally, within equities, I think, we still like the Canadian market for its cyclical properties, and against its background of inflation that, yes, should definitely peak, but remain above average. Economic growth and also is expected to remain above average, even though it should taper a bit coming off the strong figures we saw last year. So that still argues for a cyclical stance within the equity market. Rate hikes also contributing to that. So the Canadian stock market should fare well because of that. But I think it's important to keep an eye on diversification as well and avoid overly aggressive deviations. So for instance, we still like the US equity market as well, even though it's clearly less cyclical than Canada, but it has the advantage of having many quality large cap stocks that quality factor, I think it's going to be an important asset this year and even beyond, considering the pressure on profit margins and the pressure on the cost of debt. So quality is an asset really important for the US equity market, and it's something that we don't see as much in abroad. So for instance, in emerging markets.
Excellent. Very well. Thank you very much, Louis. That's all the time that we've got today. So thanks again for sharing your thoughts on the market with us. And everyone, thank you once again for tuning in. We will be back with another top of mind topic very shortly. Thank you.